It's a beautiful Friday morning. Thank you for joining us on Business Morning. I am BC Adebayo. The Organization of the Petroleum Exporting Countries has again slashed its forecast for global oil demand this year due to the coronavirus outbreak and says that the reduction may not be the last. In its closely watched monthly oil market report released on Thursday, the cartel now expects global demand to contract by 6.9 million barrels per day or 6.9% in 2020, while demand for its crude is seen down by 5.4 million barrels per day compared to 2019 at 24.5 million barrels per day. OPEC hints that the sharp contraction in global oil demand amid lockdowns and stalled industrial activity will lead to the lowest demand for OPEC crude in more than 30 years this quarter. Meanwhile, oil prices are trading around $28 per barrel today, and Brent crude is up 2% at about $28.37 a barrel in early trade, while U.S. crude was down 0.7% at $19.74 a barrel. Yesterday, Moodys Ratings agency affirmed its rating for Nigeria's economy to a B2 due to what it describes as downside risks to the country's creditworthiness. The global ratings firm says the risks have increased due to the oil price shock and the financial and economic implications of the coronavirus outbreak. Well, I'm being joined by the managing director at AfriInvest Securities, Ayodeji Ebo, for an analysis of the report. Good morning, Ayodeji. Of course, Moody's had late last year released its ratings on Nigeria, hinging it on the risks surrounding the macroeconomy back then. But yesterday, it says that those risks have increased and have been exacerbated by the oil price shock and the financial and economic implications of COVID-19. What are your thoughts on this?
Yes, thank you. The rating, you would recall that last year, Moody downgraded Nigeria in rating to the B minus. And what we've seen is why they are reaffirming in terms of that rating, which contrary to what we saw from S&P and Fitch in the last few months, it's because of some of the conditions they highlighted in the report. So they have, in terms of the criteria that they use in terms of the yardstick or coming up with the rating, it's a valid point that the continued spread of the COVID-19 as well as the low oil prices has increased or amplified the threat for Nigeria. But what they also look at is, if you look at in terms of our debt to GDP ratio, though it's more practical to look at debt to actual revenue, but we're still around 19%, which excludes federal government's contingent liabilities. And your IMF threshold is about 55%. So that still looks very moderate. And the B rating, which affirms for the long-term issuer, still emphasizes that we have that we are able to meet our financial obligations based on our current threshold. If you also look at how our loans are structured, most of them are long-term, average of about 14 years. So we don't expect that most of those obligations would fall due anytime soon. So by and large, I feel that the reaffirming of their last downgrade or their last rating is still in line with other rating agencies because they are all non-investment grade. Which increases the risk premium that will be placed on Nigeria if we want to raise debt.
What does this say about Nigeria's creditworthiness, even as the government has indicated plans to increase domestic borrowing soon?
Yes, you would look at in terms of the creditworthiness, as long as we borrow in Naira, would the federal government with support of also the CBN, would also be able to meet those obligations because you have control over the currency relative to borrowing in dollars. But borrowing abroad or raising euro bonds now is no longer very attractive because of the sell-offs or the pull-out of foreign investors from emerging markets. yields currently average around 11%. And when you look at the average yield on FDM bonds, which is around 10.7%, it shows that it's cheaper to actually borrow in Nigeria, because when you need to factor in the devaluation risk that you may also experience if you borrow in dollars. So I feel that it has nothing to do in terms of the creditworthiness. Nigeria will still be able to meet its obligations. Most of those bonds are long-term and they don't fall due immediately. It's you look at it, for instance, it's like a bank that for most of the banks cannot, there's no bank that can survive if there's a run on the bank, as long as they continue to receive deposits and people don't collect their funds at once. So what we would see is upon government will just plan ahead. Upon every maturity, they would be able to plan ahead in terms of repayment. But when you look at in terms of the Nigerian Treasury bills angle, you would discover that most of those maturing bills are also rolled over. So in terms of the obligation to meet that, to pay off the investor, they are able to sort that out immediately. So what we would likely see is more of trying to issue more bills or issue more instruments that will be higher than what is maturing, so that they are able to meet the maturing obligations, as well as also have more funds to be able to use to fund the budget.
Well, the agency also affirmed Nigeria's B2 ratings due to its low debt burden in relation to the GDP and, of course, the low annual borrowing requirements, low external debt service needs, among other issues. But it adds that over the next few years, Nigeria will need to borrow more. So why then are some analysts berating the federal government about becoming heavy with borrowings?
Yes, I think the analysts are very correct in terms of being concerned, because the best way to view it is to look at what is the proportion of our debt as a proportion of the actual revenue. So if you look at it, it's almost close to 100%. If you it based on actual revenue, I'm not talking about projected revenue in the budget now. Last year, average the actual revenue was around 4.2 trillion. So, and when you look at also debt servicing, it's almost close to 4 trillion. So you would see that it's almost getting close to between 80 and 100%. So that calls for concern. But government would also look at other avenues, and that's why you would discover that government trying to increase VAT to see how they can ramp up non-oil sector revenue. Though that will not yield much for the federal government, the VAT, in terms of how it's structured, about 52% goes to the state government. So the federal government has, the state government have more to benefit from this. What the government should look at is other sources of funding that they can use in the interim. This is a crisis situation where they need to, based on projection, even from the IMF, where the IMF is projecting that Nigeria would record a negative growth about 3.4% in 2020. It means by the time we record about two negative quarters, we'll record about two negative quarters of negative growth. It means Nigeria would be in a recession. So how do we want to spend our way out? We need to spend more. So those other sources of revenue, they need to look at. A lot of the moribund assets, they should see how they want to sell off some of these assets and free up cash. Some of the holdings they have in some of their companies, parastatals that are performing, they can reduce their stake to also raise capital from this, which they can use to invest more into more capital projects that would help unlock potentials within the economy.
Also made comments about the possible capital outflows, saying that the pressure on Nigeria's fragile balance of payments will worsen and even threaten external stability. Help us to understand this statement.
Sorry, can you repeat that?
One of the key aspects of the Moody's report is the fact that they commented on the possible capital outflows, saying that the pressure on Nigeria's fragile balance of payments may actually get worse, and that could threaten external stability.
Yes, they are right, but we've been seeing that even before now. We've seen significant outflow. If you look at across even the emerging market, about $83 billion has been taken out across emerging markets, which also impacts also on Nigeria. We've seen the significant pressure that within the FX angle, the FPI is trying to sell down on their fixed income investment as well as the equities. So we've seen that outflow. We've seen that outflow significantly in the last few weeks since the spread of the COVID-19 started significantly. So Nigeria is we've already been impacted by that flow. We don't expect to see much of a capital outflow again. But what we need to see how we want to work on is what can we do to attract foreign direct investment? Because for most times, once there are shock or destabilization like this, the foreign portfolio investors would always want to move to safety. And that is if we don't come up with a strategy for us to attract long-term inflows that can help even generate jobs, can help build the economy, then would continue to be vulnerable to all these external shocks once they come up.
Now, here's another part of that report now, that the sovereigns are very low institutions and governance strength is likely to constrain the effectiveness of government's measures to buffer the impact of the economic and financial shock. Of course, this sounds like a statement to the policymakers, right?
Yes, I think they are trying to also emphasize that policymakers need to sit up. I know they are trying their best, but most times you only judge people based on results. So no matter the activity that you're putting in place, no matter the policy that you're formulating, it is about the implementation and effectiveness of those policies. It's still based on how Nigeria is structured. Even within this COVID-19 crisis, government is coming up with palliative structure to see how they want to reduce the burden on Nigerians, but really don't have a structure. In terms of when you look at the number of those that are still excluded in the financial system, how do they intend to get funds to some of these guys? Do we have a database that is reliable to know those that are really unemployed that you also want to fund? So these are major germane questions that they are also asking for policymakers. A lot of policy has always been formed, evolved, but in terms of the implementation and its effectiveness, so we need to see government doing more in terms of trying to measure how effective some of those policies, CBN intervention programs into the agri sector, into the entertainment sector. Can we measure the effectiveness? Can we see how, in terms of the contribution to growth? So we need to run some of those scenarios and see those impacts, such that if we can see at every 100 billion or 200 billion that we spend, it's going to, the implication will be 0.2% on growth. So if we do all those scenario analysis and we can see whether it actually translates into the growth, it translates into generating more jobs, then we'll be able to know whether to channel more effort into some of those areas, so that at the end of the day, it would impact positively on growth, and we can see tangible results and not just based on policy formations.
Well, why we wait to see those impacts? Now, the agency also mentions that there are indications that the government is contemplating participation in broader debt relief initiatives. And it looks like Moody's is not quite confident about this. Of course, it sees this having negative consequences for the private sector creditors. Do you share the same thoughts?
Yeah, so in terms of for us trying to get a debt relief, I believe you also need to take advantage of situation. So Nigeria is trying to negotiate the debt relief based on some of its multilateral loans. I think it's just trying to take advantage of this COVID-19 situation so that we can, going forward, we can reduce our debt servicing or our debt burden. But we know that the rate at which we continue to accumulate debt is also very alarming. So even when we get that debt relief, or we are able to restructure some of those debts or external loans, then it would very soon it will also quickly very accumulate, and we may also get to that same that same spot again. But it's critical because now we are constrained low oil prices. Even with the budget benchmark for crude has been reviewed to $30, we still see that it's still trading below even that benchmark. The projection for non-oil, that would also have been impacted with this lockdown. A lot of companies are not working. So how do you charge based on your expectation of VAT? Even for the oil companies, based on your expectation of the royalties that you're supposed to get. Some of all these things would really be impacted. So this is the time, though this is the time that we don't have a choice than to see how we want to borrow more. And I feel that's why government is looking at the $6.9 billion, about I think $3.4 billion from the IMF, based on trying to draw down its special drawing rights, the drawing rights quota. Also about $3.5 billion from the World Bank and about $1 billion from AFDB. So these are just one, to see how they want to support in terms of palliatives to reduce the burden on Nigerians. But the concern that would also still arise is that how do they get these funds directly to those that really require it? How do we help to support such that the impact in terms of job losses, impact in terms of people suffering from not being able to, for those that earn daily income, now that they can't earn any income, how do they survive? These are some of those things that even before those funds are released, or even if they are released to us, those are the valid questions that they will be asking the policymakers.
What about the domestic capital market? Now, the agency sees that markets being able to absorb higher borrowing needs by the government at moderate costs. Will that in any way be due to the current relatively low exposure of the banking system to government securities?
No, I feel that what would see when you look at the budget that has been reviewed, the budget deficit has been increased to the budget deficit have increased to about 5.2 trillion. But by the time you look at actual, based on actual projection, if you look at the trend they've been doing in the past years, you would see that this budget has a deficit of about 6 to 7 trillion. How will government fund it? They just have to focus on raising it locally. Yes, it may impact in terms of how crowding out the private sector, but with the low interest rate environment that we see, though we expect that with the need to raise capital, interest rates may shift upwards slightly before the end of the year because government needs to fund its obligations. But we feel that with this, if interest rate remains within the single digits rate, then we would still continue. We would see the impact in terms of the interest environment still be very low. That will not impact in terms of the cost of borrowing from the government, and that will not have a significant impact in terms of crowding out the private sector.
Managing Director at AfriInvest Securities, Ayodeji Ebo, thanks for joining us on the program.
Yeah, my pleasure.